Traders analyze price charts to identify recurring patterns that can indicate potential trend reversals or continuation. Symmetrical triangle. A symmetrical triangle is a chart pattern characterized by two converging trend lines connecting a series of sequential peaks and troughs. These trend lines should be converging at a roughly equal slope. Symmetrical triangles occur when a security's price is consolidating in a way that generates two converging trend lines with similar slopes. The breakout or breakdown targets for a symmetrical triangle is equal to the distance between the initial high and low applied to the breakout or breakdown point. Rectangle pattern. A rectangle is a chart pattern formed when the price is bounded by parallel support and resistance levels. A rectangle exhibits a period of consolidation or indecision between buyers and sellers as they take turns throwing punches, but neither has dominated. The price will test the support and resistance levels several times before eventually breaking out. From there, the price could trend in the direction of the breakout, whether it is to the upside or downside. A bullish rectangle is formed when the price consolidates for a while during an uptrend. This happens because buyers probably need to pause and catch their breath before taking the pair any upper. A bearish rectangle is formed when the price consolidates for a while during a downtrend. This happens because sellers probably need to pause and catch their breath before taking the pair any lower. Ascending and descending triangle. The ascending triangle is formed in a downtrend and indicates a continuation of the downtrend. It is formed as a right-angled triangle with a resistance and a slope of higher lows. The resistance does not allow the prices of the securities to move more upward. The breakout of the prices is confirmed when the prices break from the triangle with volume and continue to move downwards. The price target can be set as the width of the ascending triangle from its high to low and then add this value to the breakout level. The descending triangle is formed in an uptrend and indicates a continuation of the uptrend. It is formed as a right-angled triangle with a support and a slope of lower highs. The support does not allow the prices of the securities to move more downward. The breakout of the prices is confirmed when the prices break from the triangle with volume and continue to move upwards. The price target can be set as the width of the ascending triangle from its low to high and then add this value to the breakout level. Flag pattern. A bull flag is a bullish chart pattern that forms within an uptrend, while a bear flag is a bearish pattern that forms within a downtrend. Both signal consolidation for a market that generally result in a continuation of the underlying trend. Now that you know what bull and bear flag patterns are, let's dig into their characteristics. The flag pole. This is the initial move in price. It can be represented by either an uptrend or a downtrend. A flag pole in an uptrend would result in a bear flag, while a flagpole in a downtrend would result in a bear flag. The flag. The flag formation is the key to this pattern. It's where the market takes a breather within the trend and consolidates for the next move. The length of consolidation isn't as important as the depth of the retracement, which shouldn't be more than about 50% of the initial move. The continuation. At this point, the market has finished consolidating and is now trending in the original direction. Using the distance we calculated above for the flagpole, we now have a measured objective for a possible target. Pennant pattern. A bullish pennant is a technical trading pattern that indicates the impending continuation of a strong upward price move. They are formed when a market makes an extensive move higher, then pauses and consolidates between converging support and resistance lines. To identify a bullish pennant, you'll need to watch for two elements. Firstly, a pronounced upward movement beforehand known as the pole. Secondly, a price consolidation that forms a roughly symmetrical triangle with its support and resistance lines. A bearish pennant is a technical trading pattern that indicates the impending continuation of a downward price move. They're essentially the opposite to bullish pennants. Instead of consolidating after a move up, the market pauses on a significant move down. To identify a bearish pennant, look for a consolidation between support and resistance after a major bearish price move, the pole. The support and resistance lines will form a roughly symmetrical triangle, showing that the market is in conflict between positive and negative sentiment. Unlike trading other chart patterns, the original range of a pennant is rarely used to plan where to take profit. Instead, the breakout often matches the size of the bear or bull move that preceded the consolidation. Wedge pattern. Falling wedge. The falling wedge shows both trend lines sloping down with a narrowing channel indicating an immediate downtrend. As the trend lines get closer to converging, the price makes a violent spike higher through the upper falling trend line on heavy volume. Rising wedge. The rising wedge is a bearish pattern and the inverse version of the falling wedge. Both trend lines are sloping up with a narrowing channel uptrend. Participants are complacent as the immediate uptrend continues to grind, but they don't notice the narrowing channel. As the trend lines get closer to convergence, a violent sell-off forms, collapsing the price through the lower trend line. This breakdown triggers longs to panic sell as the downtrend forms. Double top and bottom pattern. A double top pattern is formed from two consecutive rounding tops. The first rounding top forms an upside-down U pattern. Rounding tops can often be an indicator for a bearish reversal, as they often occur after an extended bullish rally. Double tops will have similar inferences. If a double top occurs, the second rounded top will usually be slightly below the first rounded top's peak, indicating resistance and exhaustion. Double tops can be rare occurrences, with their formation often indicating that investors are seeking to obtain final profits from a bullish trend. Double tops often lead to a bearish reversal, in which traders can profit from selling the stock on a downtrend. Double bottom pattern. A double bottom is formed following a single rounding bottom pattern, which can also be the first sign of a potential reversal. Rounding bottom patterns will typically occur at the end of an extended bearish trend. The double bottom formation, constructed from two consecutive rounding bottoms, can also infer that investors are following the security to capitalize on its last push lower toward a support level. A double bottom will typically indicate a bullish reversal, which provides an opportunity for investors to obtain profits from a bullish rally. The price target should be equal to the distance between the neckline and the tops. Triple tops and bottoms pattern. A triple top chart pattern is a bearish reversal chart pattern that is formed after an uptrend. This pattern is formed with three peaks above a support level neckline. The first peak is formed after a strong uptrend and then retrace back to the neckline. The formation of this pattern is completed when the prices move back to the neckline after forming the third peak. When the prices break through the neckline or the support level after forming three peaks, then the bearish trend reversal is confirmed. A triple bottom chart pattern is a bullish reversal chart pattern that is formed after the downtrend. This pattern is formed with three peaks below a resistance level neckline. The first peak is formed after a strong downtrend and then retrace back to the neckline. The formation of this pattern is completed when the prices move back to the neckline after forming the third peak. When the prices break through the neckline or the resistance level after forming three peaks, then the bullish trend reversal is confirmed. The price target should be equal to the distance between the neckline and the tops. Cup and handle pattern. A cup and handle pattern is a pattern of price movement on the trading chart that resembles a cup with a handle, from where it derives its name. The cup section of the pattern is formed by a U-shaped price movement, while the handle is a short price channel from the edge of the cup. The handle is actually a pullback after the right swing of the cup. The pattern is of two types. In the bullish type, which occurs in an uptrend, the pattern is formed by a downswing, pullback, that gradually turns to an upswing in the trend direction, and then followed by a small pullback, a slight downward drift that forms the handle. The inverse, bearish type, which appears in a downtrend, is formed by an upswing, pullback, that gradually turns to a downswing to continue the downtrend, but then slightly pulls back again, the handle. The cup and handle pattern can form in any time frame, but as a swing trader, you should focus on the daily time frame. Head and shoulders pattern. The pattern appears as a baseline with three peaks, where the outside two are close in height and the middle is highest. The neckline rests at the support or resistance lines, depending on the pattern direction. A head and shoulders pattern has four components. After long bullish trends, the price rises to a peak and subsequently declines to form a trough. The price rises again to form a second high substantially above the initial peak and declines again. The price rises a third time, but only to the first peak level, before declining again. The neckline, drawn at the two troughs or peaks, inverse. The first and third peaks are the shoulders, and the second peak forms the head. The line connecting the first and second troughs is called the neckline. The opposite of a head and shoulders chart is the inverse head and shoulders, also called a head and shoulders bottom. It is inverted, with the head and shoulders bottoms used to predict reversals in downtrends. The price falls to a trough, then rises. The price falls below the former trough, then rises again. The price falls again, but not as far as the second trough. Once the final trough is made, the price heads upward toward the resistance, the neckline, found near the top of the previous troughs. The second trough is the lowest, the head, and the first and third are slightly shallower, the shoulders. The final rally after the third dip signals that the bearish trend has reversed, and prices are likely to keep rallying upward. The price target should be equal to the distance between the neckline and the top of the head.